Hey guys, welcome to the next episode of the Nomad Show. So, in this episode, we're going to focus on the difference between the short term contracts and the long term contracts. So, by short term, we are referring to, let's say, an option contract that's expiring within the week itself, or let's say the following week, right? So, these are very short term. Whereas for longer term, we define here to be something that is, say, like a year, all right, or later. So it doesn't expire so quickly, right? So the midterm ones are those that is going to expire, let's say, in a few months' time. So what are some of the differences when trading between the short-term contracts and the long-term option contracts, right? So these are some of the points that we'll cover below. Okay, so the first key thing, right, is that the strategy involved will be very different. So when we are trading shorter-term contracts, we are looking for a fast in, fast out approach because again here time is of the essence because the contract is going to expire. So we have to exit the position very quickly, right? Otherwise, we'll be stuck with a contract that's going to expire in a few days' time, right? Whereas on the other hand, for long-term contract, we are able to hold, right? So in terms of the strategy, for shorter term, we are more like buying and selling quickly. Whereas for longer term, we are buying and we are holding it, right? So when we hold to the contract, whether a call option or a put option, right, forecasting, right, or we are confident that the stock is going to move in a certain direction, right, in the weeks to come, in the months to come even. Okay, so and we want to ride on that big trend, right, the big movement because it may not happen within the next day, right, or it may not happen in this week itself, but say a random day, right, over the next 3 weeks, there could be a certain, right, or there could be a certain pump in the market where the stocks just fly, right, 10% or more, or it dumps 10% or more, let's say in the pre-market. Right? So when we are able to hold for a longer term, right, we're able to ride all these trends, and we could see a bigger movement, right, in our option profits as well. Okay, so I would say the first difference here is in terms of the strategy. Now, the second thing is in terms of the time decay, right? So again, in the previous episodes, we have mentioned that for option contracts, they always come with an expiration date. So as each day passes, the option contract is going to lose a bit of its value on its own, right? So suppose everything else stays the same, there is no change in the stock price and so on, right? Every single day, the contract loses a bit of the value. Now, how much it is depends on how short, right, or how little time there is to expiration. So a contract that's going to expire in 2 days' time, right, versus one that's going to expire in 1 year's time. So the one that's going to expire in 2 days' time will have a higher theta, right? So theta referring to the time decay. So it'll be very high because it only has 2 days left, right? So it's either a make it or break it situation. Whereas for a contract that's going to expire in 1 year's time, right? Because there's so much more time, so much more runway, it is able to hold on to wait, and the time decay is now very much minimized, right? Because every day is just one out of the few hundred days left, not just 1 or 2 days left. So the time decay is more subdued in this case. Okay, so the second difference is in terms of the time decay. Now, the third one here is in terms of the risk. Of course, with risk comes the reward itself. So for shorter term contract, right, because the time decay is high and there's probably going to be more movement, right, or more volume of trading. So the prices are going to be more volatile. So suppose now the contract expires in 2 days' time, right? We have a call contract and the share suddenly pumps up 10%. We're going to see more movement, right, in the shorter term contract. So it could jump by say 50%, 60%, right, in terms of the profits. Whereas at the same strike price, but a longer term contract, it could maybe jump just 20%, right? Because it's going to be more stable, more gradual in terms of its movement in the price. Okay, but conversely, of course, if the stock price goes against us, right, then for the shorter term contract, we're going to see a very fast depletion, right? So it could very quickly go to zero or near zero for the contract price because technically there's only 2 days left. And with that big movement against us, right, it makes it almost impossible for the contract to be worth anything on the expiration date itself. Conversely, for a longer term contract, because it has so much more time, the chance of recovery of the stock price is going to be higher. And also because there's so much more time, right? Time also has a certain priced into the contract. So in that case, the contract will still retain more of its value of the price because of the time left. So this will be another difference in terms of longer term contract and the shorter term contract. Right? Now the last point between both is in terms of the capital required, right? So in terms of the shorter term contract, they're going to be cheaper, right? The time value is very limited, right? There's only 1 week or say even the same week left. So in that case, the contracts will be much cheaper, and because of that, it will be more affordable to traders, especially of smaller capital. So if I have a portfolio of just $5,000, I can trade many more short-term contracts compared to long-term contracts. And if I don't want to tie down a large percentage of my portfolio with just one long-term contract, then I will consider trading the shorter-term contract. All right, but in this case, of course, with the shorter term contracts, right? Because it's cheaper. With the same portfolio, let's say $5,000, we can buy more contracts. We can buy two, three, four. Whereas for the longer term one, we can just buy one. Right? So or two in that case. So in that case, in terms of the capital requirement, a shorter term one is going to be smaller, right? It's going to be less demanding on our capital compared to the longer term contracts. Okay, so these are some of the key differences between the shorter term and the longer term contract, right? Now, pretend depending on right the specific buyer itself or the trader, right, someone who is more risk averse, who wants to have a lower risk, right, of losing everything, then they may be more advised, right, to trade a longer term contract, right? On the other hand, if someone is more of a risk taker, and if say they are starting with a smaller capital and they don't want to risk a high proportion of it, right, on just one position, then a shorter term contract may be more advisable. Okay, but of course, this depends on our specific strategy, our risk appetite, right, on the specific prices of the contracts itself. So there are many variables to consider. Okay, so if you guys are interested to learn more, feel free to watch the videos on this channel, right, to find out more about options trading. At the same time, if you guys are interested in a more comprehensive course or membership, then we actually have just launched our new product, right? The link is found below. So you can actually check out, right, our resource. So in this membership itself, right, we have made it very affordable. Option trading is now more accessible to everyone. And we want to introduce this concept where the membership is ongoing, so that apart from just the training resources, right, that comes with courses and so on, but we also want to provide regular updates about the market situation, okay, so that you guys are not left in the lurch, right, after finishing your course and it just stops there. Okay, so if you guys are interested, feel free to see the description box below, right, for the link. So hopefully you guys have learned something from this video, and I'll see you guys soon. All right, bye bye.